If you had saved $10,000 10 years ago and never touched it, most people would say you did something responsible, disciplined, safe, financially intelligent. But there is a problem. That $10,000 has been shrinking every single day. Not because somebody stole it, not because the bank lost it, because the system was designed that way. Most people think money stored in a bank remains unchanged. The number stays the same. The balance doesn't move. The illusion feels comforting, but the global financial system doesn't measure wealth in dollars. It measures wealth in purchasing power, what your money can actually buy. And over the last century, purchasing power has been systematically diluted, sometimes slowly, sometimes violently. The result is one of the largest wealth transfers in modern economic history, not from poor to rich, not from one country to another, but from people who merely save to people who own productive assets. This is where most financial advice misses the bigger picture. The question isn't how much money you save. The question is, what happens after you save it? Because saving and investing are not competing strategies. They're two different stages of the same process, and understanding the difference may be one of the most important financial realizations of your life. To understand why saving eventually becomes investing, we first need to understand the architecture of modern money itself. Most people imagine money as a storage device, a container of value, a vault. But modern economies view money very differently. Money is fuel, and fuel is designed to move, not sit still. Every major economy depends on spending, borrowing, lending, investing, production, and consumption. Growth is not a side effect of the system. Growth is the objective. Governments need growth to manage debt. Corporations need growth to satisfy shareholders. Banks need growth because lending generates profit. Investors need growth because asset prices depend on future expansion. The entire structure is built around one assumption: tomorrow must be economically larger than today. That creates a hidden consequence. If growth is required, money sitting idle becomes increasingly inefficient. While your cash remains stationary, the rest of the economy continues expanding around it. New businesses emerge. New technologies increase productivity. Corporate profits compound. Real estate develops. Supply chains evolve, capital keeps moving, and moving capital attracts rewards. Static capital does not. This is where the public narrative becomes dangerously incomplete. People are told to save money, and that advice is correct, but only for the first phase. Saving solves a liquidity problem. Investing solves a purchasing power problem. Those are not the same thing. Think about what happens inside a bank. You deposit money. The bank doesn't lock it inside a vault, waiting patiently for your return. That money becomes part of a lending system. It enters mortgages, business loans, commercial projects, and financial markets. Economic activity begins immediately. Your money starts working the moment it enters the system, just not necessarily for you. This is one of the most important realities in finance. The institutions holding your money understand something many individuals never fully learn. Cash is a temporary vehicle. Ownership is the destination. Banks understand it. Corporations understand it. Pension funds understand it. Sovereign wealth funds understand it. The question is whether the average person understands it before decades pass. When people hear the word inflation, they often imagine a sudden crisis, runaway prices, economic panic, currency collapse. But the more powerful version of inflation is the quiet version. The version that operates year after year, almost unnoticed, a few percentage points at a time, small enough to ignore, large enough to transform entire lifetimes. This is why the transition from saving to investing isn't about becoming reckless. It isn't about chasing risk. It isn't about stock market excitement. It's about recognizing a structural reality. The system continuously rewards ownership of productive assets because productive assets participate in economic growth. Cash generally does not. And once you understand that, saving stops being the destination. It becomes the starting line.